COVID-19 was once again the dominant theme this quarter, with new strains of the virus such as the highly infectious Delta variant having emerged. And on a related note, another key theme was the ongoing vaccination drive across the globe, with developed nations still far ahead of emerging economies on that front. Another key theme was the sharp rise in US inflation, which then gave rise to some concern that the Fed might need to begin tightening policy sooner than expected. And then finally, apart from the collapse in cryptocurrencies, we saw the country go back to level 4 lockdown, while former President Jacob Zuma was handed a 15-month jail sentence for contempt of court. The South African equity market took a breather in June after having risen for 7 consecutive months, resulting in the JSE posting only a slight gain for the quarter. Resources shares are what weighed on the market, with the sector giving back some of the substantial gains it delivered in prior quarters. South African bonds outperformed local equities, with nominal bonds doing particularly well, despite higher inflation being seen locally. And then lastly, foreign equities did better than local equities this quarter, even though the rand strengthened. The US was a key driver, with large cap technology stocks coming to the fore once again, as the value rotation seemed to peter out a bit. The global economy is rebounding at a rapid pace following last year's contraction, and we are witnessing a synchronized recovery. Both the IMF and the OECD are expecting strong growth this year, having revised their growth forecasts higher, and both expect growth to moderate slightly next year. Underpinning this is a policy backdrop which is still very supportive, while economic reopening, which is underway, is also supportive of growth over the medium term. Economies that are well advanced in their vaccination programs are, however, better placed than many other emerging markets, where the vaccine rollout has been slower. Growth in South Africa is following a similar pattern to offshore, with a strong post-recession rebound underway. There are worries, though, that the pace of growth is likely to revert back to its historic subdued level, with our slow economic reopening and post-quarter end riots both counting against us. What is encouraging, though, is we are seeing momentum building in political and economic reforms, which could create positive surprises down the line. There is also scope for the mining sector's prosperity to filter through to the rest of the economy and for further green shoots to materialize. The portfolios remain well positioned to participate in the current opportunity set. One such opportunity is the increasing attractiveness of South African equity, where attractive valuations and slightly improved economic prospects could bode well for future returns. Foreign equities are still very well placed given the macro cycle, and while valuations are elevated, growth prospects still justify our current overweight. The portfolios retain their full weighting in South African government bonds, which offer very attractive yields relative to our assessment of risk, and given where cash rates are, and we're still quite negative on global bonds. The outcome of our positioning across asset classes and high conviction managers has once again resulted in pleasing performance across the range this quarter. For more information on our current thinking, please read the latest edition of Talking Points available on our website.